Hey guys, and welcome back to the show where we talk about everything stock related. So we look at different trading strategies, we look at different techniques, we look at what's happening in the market in real time and how this can benefit you. So in today's show, what we're going to actually be talking about is how does the stock market differ from putting your money in a savings account at the bank. So first of all, we're going to look at what the a savings account at the bank is, and we're also going to look at the stock market. We're going to look at the pros and the cons of each, and then we'll be able to answer the question after. So a savings account at the bank is, so commercial banks really are a deposit taking institution. So what that means is that you are able to go, you open up an account and you hand them your money and they take it, and what they do is they give you an interest on top of that money. So the money that you would invest in the commercial bank will be yours. Now, when the commercial banks take your money, what they do is they lend it out. And so that's how they are able to actually extend the operations of the bank and really make money, and then they are able to give you an interest based on that spread. So with commercial banks, that is their primary basis of business. So what they do is they take short-term deposits and they give it out and make long-term loans. So whether you're borrowing to purchase a house, car, real estate, investments, those sorts of stuff, commercial banks will lend you that money once you're able to actually manage it. Now, the benefit of having a savings account is that it's easy to access the funds. So you can actually deposit your money and you can withdraw it at any time, no hassle, no problems. And also with commercial banks nowadays, you actually get debit cards. So if you have some money in the bank and you are out shopping or an emergency arises, you no longer need to actually go to the bank and join that line to withdraw the cash. You can just pull out your debit card and you can swipe it or tap it. And even now they actually have Apple Pay, so you can just put the card on your phone and you can use that and you pay at the merchant, the supermarket, your groceries, those sorts of stuff, and you will be able to have it. So the purpose of a savings account is that it is really secure, it's safe. Your funds are insured up to an amount, up to a limit. So if the bank becomes illiquid, like what had happened to Silicon Valley Bank about a year or two ago, and they had become illiquid and they had to sell off all their assets and repay the shareholders, and then the Fed decided that they were going to insure up to only about $750,000. So if you had invested $1 million in savings at that bank, you'd have lost 250,000 because they only insured up to about 750,000. So the average depositor isn't gonna have to $750,000 in their account. So having that funds in the account is safe, it's secure. It in the event of emergencies, you need cash. If you need to sustain and manage your day-to-day life, then those are the benefits of the savings account. Now, the disadvantages of having a savings account is that, well, if the bank becomes illiquid, then they'd have to sell off all the assets and repay you back your funds, and it's only insured up to a limit. Another disadvantage is that the interest that you get on the savings account is very minuscule. So right now the interest rate is less than 2%. And so with interest being that low and inflation currently at about 2.75%, then you technically are losing on your real value of the money that you have. And so if you take your money and you put it in a savings account, then there isn't any chance that money is gonna grow. So if you put $1,000 in the savings account and you withdraw it at the end of the year, you maybe see $20 on it. Maybe. You probably see $10 or $5 or even less. So with that, the savings account, it's great in terms of if you need liquidity, if you need to have funds readily accessible, you need to have an emergency fund. If you're traveling, then this is great to have. And the downside to savings account is that your money does not grow. So if you're looking to increase your net worth, then this is not where you should store the funds and where you should keep it. Now we're going to move on into the actual investing in the stock market. Now, stock markets is a whole new world. It is different from the banking world. So stocks is invested, and investing is really where people go to really increase their funds. So the stock market, as the name suggests, is where buyers and sellers meet, they come together, and they are able to actually trade in shares of a company. And shares are really just units or partial ownership within that company. And so when you actually have an investment account, and that is more so a stock account, now some of the advantages of having that stock account and investing in stocks is that you can benefit from capital appreciation. So if you invest in the stock market and the stock you are investing in increases in value, you too will benefit from that increase in value. So it will actually be an unrealized gain that you will have. And if you decide to sell it now, then that would be realized. So let's say you invest $1 in a stock and it goes up 100%, that would be $2. Now, if you choose to sell it, you'd have gotten $2 and that would be realized gains. If you don't sell it, that $2 is unrealized. So let's say you take that $1, you invest it in the market, 3 months pass and the stock falls to 50 cents. And you don't sell it, so that would be an unrealized loss at 50 cents. Now if you hold it for another 2 years and it goes up to $3, then that would be unrealized gain of 200%, which is $3. If you decide to sell it right there, that $3 would now become realized because you actually sold it. And so by selling it, that which was unrealized at the time, which would have been you just holding that value, and that market appreciation has now been fruitful and tangible, and so you can benefit from that. And so with that, another advantage with investing in stocks is that you are able to get dividends from the company. So if the company issues dividends, then you would likely benefit from it as well too. So depending on the amount of units that you have in this account and in this company, then it will determine the amount of dividends you would get. And dividends really is just cash back that you're getting. So if the company decides to pay, let's say 34 cents per share, and you have 1 share, then you're gonna get back 34 cents. But if you have 1,000 shares, then you would actually get back $340, and then that would be 340 less taxes. So that really is how the stock markets differ from the savings account. And the disadvantages when it comes on to stock markets is that, and stock investing, is that your capital is not protected. So whatever money you invest in the market, it is prone to being lost. It's not a guarantee, but it is possible. So you have capital risk. So you have to look at the risk that if you invest $1,000 in the market, you might actually lose part or even all of that money because of different things. Because companies can actually change direction, they can delist, they can become insolvent, and so or the company might not just be performing well, and so the value falls down. And so this really is what it comes to when it comes on to the risk involved in investing in the stock market. And so you have to take this into consideration. So you might be wondering, what is the best? Is stock markets better or saving in the bank account better? Now, it really depends on your circumstances and you as an individual. So if your goal is to have an emergency fund, if your goal is to have liquidity, if your goal is to have that stability and just have that funds in the event that something might arise, then savings account will be better for you. But if you're looking to grow that funds and to grow your net worth and to increase and improve in it and to really become a part owner of a company that you might love or just are attracted to what they do and you agree with their mission, then the stock markets would be better for you. Now, it really depends on your circumstances because everybody's circumstances is different, and trying to categorize everybody into one category is impossible really. So the best thing to do is to really know what you want, what your objectives is, and then go after it. Now, a lot of persons have both savings and investment account. So what they do is that when they get their salaries or their income on a monthly or bi-weekly basis, what they do is that they'd have that savings account and the money is in it, and then the extra income that they have left over, they invest that. And so what that would mean is that they are now able to grow their network. They're now able to take on that additional risk that the savings would not give them. And so having a combination of both is actually good. So that's really all that I have to say regarding this. So with regards to investing in the stock market or actually having a savings account, now savings account really are just created for persons to store their funds, to have liquidity, and to actually just earn a little bit of interest on their funds. But the interest that they would be earning would be really less than what the current inflation rate is, and so they'd actually be losing money in real time on their funds. The stock market, on the other hand, investing in the stock market actually allows for persons to grow their capital, and by growing their capital they will be able to increase their net worth, and they'll be able to become a part owner of a company that is publicly traded. Now, the downside to investing in the stock market is that your capital is not protected, so you are susceptible to the risk of partial or all of your investments that you would have put in the market. There's also the risk of illiquidity within the company, so the company can shut down and they have to sell off all their assets, and then you get paid at the end after the other preferred shareholders, bondholders gets paid. And there's also the risk that the company can delist. And so when they delist, what they usually do is just they come up with a share price, they pay you, and they say thank you very much for investing with us, but we are going to do something different. And so these are just a few of the disadvantages with investing in the stock market. So it really boils down to you and what your objectives and your goals is when it comes down to whether you're deciding whether you should continue savings in a bank account or investing in the stock market. So thank you guys so much for tuning into this episode. If you do like it, I ask you to give us a thumbs up and share this with a friend who you might know who would benefit from this episode, and also give us a follow so that you do not miss out on any new episodes as soon as they are launched. And leave any comments you have down below. I love when you guys comment and I want to hear them. So hit me up, give me a comment. I'll respond to you guys. Until next time, take care. Love you guys. Bye.